In this week's update, what to do now about gold, Nasdaq consolidation or major top, and time for portfolio rebalance, but only in a very particular way. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. I thought I'd replay the first slide that I showed from last week because it's still very relevant, perhaps even more relevant. And that's just about the bigger picture of sitting back and taking stock and how to best deal with this market, which is really quite extraordinary in a number of ways. So I'll just go through this quickly. So if your objectives, and I think this will apply to pretty much everybody, if your objectives are to do this, to reduce the short-term drawdowns or volatility, if you don't know what the term drawdowns means, so reduce the impact of short-term negative moves, and therefore reduce the stress on your psychology. And I think everyone would pretty much fit into that basket. You want to get on board the new unfolding trends, and you want to amplify your profits so that they're outperforming the index, and outperforming the index by a comfortable margin. It's all about risk and reward. Now, numbers 2 and 3 are reasonably standard, basic things to do. And many people can do those, but it's the first one that gives people the most trouble. And that's really the mind game, the psychological impact of what's happening in the market. And I can tell you, it's not going to get any easier, but that doesn't mean that it's too hard. By the same token, you've just got to get onto a railway track that's well-defined, and it's straight, and it's relatively easy to stay on if you've got the right set of rules and the right sort of environment to operate in. Last week I said working with volatility, not against it. It's a pretty obvious thing to say once I've said it, but it doesn't occur to most investors in the heat of the moment. It's just not the first thing that you think of. You're somewhat stressed and stretched, and so your mind goes to very short-term fixes. What do I do to relieve this stress? Without thinking of just some very simple, basic things that you could be doing, like using volatility to advantage, look for opportunities to do that, and not be a victim of volatility. So we manage the risk by just stacking the odds. We can just do things that put the odds in our favour. They don't guarantee an outcome, but they just, one after the other, they just stack the odds in our favour. And they're very simple to do. But most people don't really think in that vein, so it doesn't occur to them. This could be done with ETFs or with individual stocks, doesn't matter. 2 filters. Filter number 1 is about making sure we're in the right fishing hole. It's about quality of stock. It's about value. It's about the probability that the business and therefore the share price will move higher over time. And then filter number 2 is we look for the shorter term signals. Is the stock overbought? Is it oversold? Plus we look at the money flows from the charts, which if you know how to read them, gives you a lot of very valuable information. And we look for confirmed turning points. And that's it. None of that is particularly difficult, but it might be different for most investors. And again, it's not because there's anything magical in those words. It's just a matter of thinking in a different way. So let's do a bit of a stock take of where the market sits at the moment, because we've got some powerful short-term directions to the upside and to the downside. It's no surprise to anybody that US tech is delivering in absolute spades, as we'll see with some of the charts in just a minute. The good thing about US tech, despite the fact that it's scaring the heck out of a lot of people just because, is that you look at their results, you look at their financials, you look at their growth, you look at their outlooks, and you just think, well, that's completely justified. Of course the price is going up. Why wouldn't it? But you've got to take the trouble to look under the hood and not just accept your gut feeling that because the price has gone up, something must be excessively overvalued. That's not the way to look at it. And you will continue to miss out on some of the great opportunities of this decade. The second thing is, will the liquidity reality? We've just had SpaceX lob with an incredible IPO. It's now worth about $2.5 trillion as a company. We've got a couple more coming with Anthropic and OpenAI and Google and Meta raising massive amounts of money. Intuitively, you would think at some point the market has to run out of money. Now, I don't know whether that's a valid assumption on my part, but it's a possibility that there's just not enough money to go around to fund all these incredible IPOs. We've now got a Fed chairman who is a lot more hawkish, in other words, more about raising interest rates to combat inflation than what the market expected. The market expected that a Trump appointee would want to lower rates because, let's face it, he had a huge stoush with the previous Fed chair, Jeremy Powell, about doing just that and criticised him all over the world. And now his appointee, it would appear, is definitely going to be sitting on the raise rates side of the equation. So that is something different now for what the market was expecting. So will that be the trigger? Because tech stocks, which have their valuation based on massive but future cash flows, the valuation models will give them a lower price as interest rates go up. So logic says there has to be a breaking point, but that's logic, and logic often doesn't work out. So let's not get carried away with logic. But certainly we are moving more and more, I think this is a fair statement, we're moving more and more towards that breaking point. Whether we reach it or not remains to be seen, but we're certainly heading in that direction. So how to play it? You've got some alternatives, and different investors will get different answers. And that's fine because we're all different in varying respects. So there is not one size fits all answer here. So the first way is to assume that a top in the markets generally, whether it's the S&P or the NASDAQ or the Australian market, we assume that a top is close in the next few weeks or few months. And we take a preemptive step and we step back, we take some full or partial profit on particular stocks and we sit and wait. The problem with that approach is you can leave a staggering amount of money on the table because some of these trends, I'm sure some of these trends will just keep going and going and going for far longer and far further than what we think is possible. And you've just got to look at history. Second alternative is that we can move to a trading stance, so a bit of a trading mentality. So we go into something and we define an exit point and we take those partial profits when the market triggers us out. Now, the issue with that is where do we place those stop losses? Because we've got so much intraday volatility and day-by-day volatility that we can be easily triggered out of a stock, which then the next day turns around and goes straight back up again. And that is almost as annoying or more annoying than having a losing trade, which just goes down after you get in. I find it far more annoying to be kicked out of a powerful uptrend because of short-term volatility. But that's a second option for some people, and that will be dependent on your psychology. The third option is to change nothing. If you're happy with your portfolio balance and you're happy with the composition of your portfolio, then don't do anything. But one of the consequences of that will be that you're going to have to work with some pretty severe volatility. So they're the options. US tech certainly in powerful uptrend. Now, commodities, critical metals, copper, other commodities are certainly lagging expectations. And now we've got, with the week just gone, we've now got a new dimension, and that is a US dollar headwind. The US dollar, as you'll see shortly, has broken out, and that means it's going to continue to impose a headwind on commodity prices. That doesn't mean that commodity prices can't go up, because there are many factors go into commodity prices. And we know that there is an incredibly high probability that commodity prices in 1 year, 2 years, 3 years and longer are going to be higher than they are now because of just basic supply and demand. It's just basic economics. More demand, inadequate supply, the pricing pressure is to the upside. But just recognise that commodities have now possibly got a longer term headwind from the US dollar. So how long will the US dollar strength derail this commodities uptrend into the future is anybody's guess, but there are more and more positives stacking up on the demand side, with the G7 just having made a commitment in France this week to critical metals. Now, we've had that implicit support from governments for quite some time, and prices haven't really kicked in, and the miner prices haven't really kicked in that much. So will this finally make the difference? It's hard to know, but certainly there are just more and more positives building up on the long-term price rise side of the equation. And that's all we can work with, just the probabilities of something happening. And it's getting stronger and stronger for commodity prices to go up in the long term. How that balance changes between currency and good old economics is anyone's guess. The sweet spot for me in the Australian market or the American market is that niche players that have got just insatiable demand, that's where they sit in their particular field of endeavour. There's just demand that they just cannot fulfill. And that demand continues on for years and years, and you put that together with very astute management, and you can get some extraordinary things happening with the company's business and therefore with the share price. We're moving into an increasingly volatile environment. Markets are getting more and more stretched, and so therefore the requirement for you to be more and more prepared has never been stronger. So just make sure that you've got all the advice that you need before you act on anything that you do in the market, and certainly anything that you do stemming from this video. Let's look at American stocks. The S&P was up about 1%, the NASDAQ 2.5%, so it was a pretty good week. And the Russell was up about 1% as well. The SpaceX IPO is doing what was expected in the short term, and that is fund flows from passive index funds continued to flow into SpaceX to play catch up. And that means that we're just getting more and more concentrated in the US market. So I thought I'd run some numbers. How many $1 trillion stocks are there? There's 12. Starting with NVIDIA, and I think the 12th one from memory is Walmart. Those 12 stocks, so 12 in all the thousands of stocks in the US market, equal $32 trillion. And the US market, there's varying figures for this, but the US market, according to Bloomberg, has a total market cap of $75 trillion. So a bit over 40% of the US market cap is contained within 12 stocks. And a lot of those stocks are concentrated in the tech area as well. So we've got this incredible concentration in market cap. So if something comes along that disrupts the psychology around AI, and it doesn't have to be factual, it just has to be the way the market starts to think. And that's a lot about perceptions. So this doesn't need necessarily a tangible figure or a tangible factor. So that's one to contemplate. So there's certainly concentration risks there. But if you step back and look at the American market, you can only conclude at the moment that we've got consolidation within a bullish trend, and I'll get to the chart in a minute. The Fed chair, as I said, Kevin Warsh, has come as a bit of a surprise to the market, that he is more orientated towards raising rates. A favourite element in the Fed's deliberations is PCE, the personal consumption expenditure, next week, and that'll be another data point for how much inflation is in the US system. People are still guessing at it. The US dollar finished at 100.5, so we've finished above 100. The 10-year yield, it's not doing a great deal, 4.46, and the VIX is at 16.5. Time to go and look at some charts. I'll start with the US dollar index because that is just really key to a lot of things at the moment. So there's the breakout. We've got a pretty strong resistance level at 100.5. We finished just a little bit above that. There's a bit of a mismatch between the data in the chart and the data point that I took when I did this recording, but that doesn't matter. We've got since early May, so about the last 6 or 7 weeks, we've got a series of higher highs and higher lows, and we've now got a breakout above a very, very important resistance level that just had multiple touches along here. The Australian dollar hasn't fallen as much as I would have thought. It's looking just a little bit more resilient than the US market is looking strong. Let's go now to the NASDAQ. But obviously the US dollar strength is creating that headwind for commodity prices, because if that continues, then it really does put a drag on commodity prices. This is the NASDAQ composite on a daily chart, and you can see that we've now possibly got a lower high, but you can't say that yet. Lower high, lower low until we break this point, which is about 25,000 on the NASDAQ composite. So we're going to have to wait for more information to see whether that happens. But I certainly wouldn't bet against the NASDAQ at the moment, because the uptrend remains incredibly strong. You've just got to look at all of the moving averages, the way that they're lined up, the way that they're flaring out. This is a trend with incredible strength. And the one thing that you need to know about the market is that when you've got such strength, then it will tend to continue in that direction. Zooming in specifically in the tech area, this is XLK, which is the overall technology sector. But then when we start to get into some of the subgroups, we've got SMH, which is semiconductors, and it's just absolutely rocketing away. We've got software, we've got cloud computing, we've got cybersecurity, but semiconductors are just outperforming all of them by a long, long way. This is the gold versus S&P ratio, and it's still not turning, obviously, with gold down and the S&P a bit higher. So we're still waiting on that ratio. Consumer discretionary versus consumer staples, just going sideways, nothing there. So no change in the indication from that side of the market. This is SMH, which is the main semiconductor ETF. It's gained 83% in 11 weeks. Thank you very much. Here's the bottom here on the 27th of March. And it finished the week in grand style, as it has tending to be. So that is certainly, you'd have to say, probably the strongest part of global markets, bar none. Let's look sector by sector now. We've got the S&P here in the middle. That's the pale green line. Everything else is underperforming the S&P because the S&P is being dragged up by XLK. So in America, it's just so much about technology and so much about semiconductors. I guess that's about all you need to know about the US market. From there, it just gets to stock selection. The Australian market now, materials were top of the tree, have been top of the tree for some time, but turned down sharply at the end of the week. That was courtesy of BHP with their cost blowout at their potash project, and also some softness in the copper price. I'll have some more to say on the Australian market shortly. The S&P looks very similar to the NASDAQ composite. So we're just consolidating after a sizzling run. And this is a little calmer, and this still gives me a good feeling for the US market as a whole, because when you start to get towards a significant market top, you start to see small caps come off the boil, and we're not seeing. So this is covering 2,000 stocks. So it's a good broad coverage, and we're not seeing too much volatility. We're seeing a really good strength in the trend. So from that perspective, things still looking pretty reasonably good. All right, turning now to the Australian market. The Aussie dollar finished at 70. Our index was up 0.3% for the week. I have no idea what will happen on Monday, because the Australian market is just diverging considerably from what the US market is doing, not only in price direction, but also in sentiment. I mentioned before the G7 meeting and their commitment to critical metals, so that's obviously important for our market. But we have now got this US dollar headwind strength, and that will impact sentiment. And it'll impact sentiment far more in this country than it will in, say, the US or Canada or stocks that are in South America. It's just the way it is. So the commodity trade is now tough with this US dollar breakout. And I'll come back to portfolio balance shortly. The AI trade is expensive. I think everybody sort of senses that, although when you look down at the fundamental metrics for some of these stocks, they're actually pretty attractive. But let's concede that certainly on sentiment grounds, AI trade is expensive. But the thing that excites me about the Australian market, and there's not that many stocks that I would put in this box, but there are some stock-specific growth stories, and we got about 5 or 6 of them in the Insiders Club portfolio that just continue to unfold and supported by the things that you want them to be supported by. And that's powerful trends, smart acquisitions, and they are providing the lowest volatility risk. The trends are so strong that the pullbacks are very brief and very shallow. And for me, that's the kind of stock I want to be overweight in this kind of market where you can wake up and find that dramatic things have happened. So that should be what investors' focus is on. Turning to precious metals, I'm not going to show the ASX 200 because there's just no point. It reflects the prices that everyone pretty much sees on the news every night, which is BHP and the major banks and Rio and those sort of stocks. Gold fell 1.65% for the week, down to 4,222. So we've certainly fallen a long way from the peak. In Australian dollars, we did get to 7,400 at one stage. We're now down just a tick under 6,000. Silver lost 4.2%, down to 67.82. But let me hasten to add that the longer term for gold and silver and platinum and palladium and a lot of other commodities is completely unchanged. The supply and demand situation has not deteriorated at all. Now, the gold to S&P ratio fell further, as I showed you on the chart a couple back, and it's certainly testing the true gold believers, that's for sure. And I think eventually, in fact, I know eventually they'll be proved right, because there's only a certain distance that high-quality gold stocks that are producing truckloads of free cash flow to make acquisitions, to make themselves bigger and better businesses, there's only so far that trend can fall. It's just, it might be very uncomfortable for some investors. So is the war done? That's absolutely the key question. It doesn't necessarily tick all the boxes for me, but there is a correlation, a very strong correlation between the activity of the war and precious metals prices. So that is the key question. GDXJ was up 2.8%, but sentiment, public opinion has certainly deserted the ship. Ratios are at an extreme, but they haven't turned. So you've got to respect that. And that's why everybody should be thinking about their portfolio balance at the moment. But certainly the financial metrics are really, really solid. And we are definitely into an acquisition phase for the developers. So long term still looks really good, but the volatility is high and you just don't know where that ends up. Other commodities, in fact, I'll go and look at gold first. So there is US dollar gold. So we've had a pullback. We've now broken below this swing low of the week ending 27th of March. It's not a particularly definitive, in fact, we didn't close below that. But certainly we're at a pretty key point, and I think I said last week, 3,900 to 4,100 was a key support level for gold. So just continue to watch that. And there's the spread between gold and US dollars and the S&P just on a shorter time frame. So other commodities, copper slipped $6.33, and we've just, no matter what we think about the long term for copper, just got to respect that currency headwind, which is what it is for the moment. Crude oil, 77, we did drop further, but it bounced a little bit at the end of the week. And the end of the war was always the risk when that happened, that the oil price would plunge, and it has, so no surprises there. But look, we've got an unknown outcome. The war could flare up again very, very easily. But I have no feel for the probabilities. And so when I don't have any feel for the probabilities, I just pass. You don't have to be in the energy trade, unless, of course, you are using it as a hedge. But I think it's an ineffective hedge at the moment because the probability is such an unknown. There is Bitcoin still clinging to that important support level. Spot copper, you can see, dipped a little bit. Certainly the copper miners dipped more than the underlying metal did, that's for sure. There's the crude oil chart. So we've had a pretty significant breakdown at 80, trying to recapture a little bit of that. We might get a bounce to 80 and then start to fall away again if the signs around the war continue as they are. So the final message, and it's a little bit of the final message from last week as well, because again, it's just the most appropriate thing that I could find to say, and that miners, more than any other sector, but the override now is that with the US dollar breakout, we're now going to have, or you should have, a longer waiting period. That would be a logical expectation. And that means that prices of miners could go lower before they resume their seemingly inevitable rise to 2030. But commodities still offer large advantages. And when you think about it, the further they fall, as long as the long term doesn't deteriorate, and it's almost inconceivable to see that it will. We're not going to stop building data centers at the rate that we are. We're not going to stop the decarbonisation of the planet. Those things just aren't going to happen. So the long term for commodities still looks amazing, but the volatility and the short and medium term downside could be beyond a lot of investors' patience and psychology. So you need to think about that. You need to think about it in advance, not when we get to the bottom, which is when most people think about it, when it gets too painful. So if you wait for the deep corrections, and I'm not saying that we've gone far enough. In fact, I'd be surprised if we have, because the US dollar has just broken out. But it means if you wait for those deeper corrections, then you've got, by definition, less downside and far more upside. And that equation is just getting more and more attractive. But you've got to make sure that you're positioned correctly. And the ultimate aim is what we're all trying to do, and that's get on with our lives comfortably, and that means far less stress and far less uncertainty from the market. That's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.